Now we're going to look at question 2. Question 2, again, is the question that's called Hudson. It's in 3 parts and, of course, includes an ethics element. The first part is about accounting knowledge. On the face of it, again, it looks very complicated, but there are some very easy marks to get. If you look at the key words, again, in the stem of the requirement of part A, the directors want to put certain things through OCI as part of the remeasurement component, which you might know as remeasurement difference or actuarial difference, but they want to put some things through there. So somewhere in our answer, we've got to explain about the remeasurement difference or component. Somewhere, as part of our answer, we've got to explain the impact of the 2 types of cost, the basic settlement cost, and then in addition, the additional contributions for those staying in the scheme. So writing or typing these subheadings first then enables me to try and get some knowledge under them. And finally, this is the bit that's easy. They want us to explain about other restructuring costs. Now that's the only bit where you're saying, well, that at least is easy. Usually, if directors want to do something in an ethics question, it's probably wrong. And so you can start from that premise when you try and answer the question. So even if you're struggling, what you might do is explain what the remeasurement difference is for. Remember, this is the cost or the income or gain or loss that goes in OCI. It doesn't go in the P&L, so it doesn't affect reported results. Investors want to look at the P&L. They're not terribly excited about OCI, so the directors want to lose these amounts in OCI. Remember that the purpose of the remeasurement difference is because the actuary makes an estimate of growth of assets. The actuary makes an estimate of increase in liabilities. It's always a bit wrong, not because the actuary is wrong, but because life is different. More people leave or join the scheme. Investments go up and down. So the remeasurement difference or actuarial difference is not for this. This is very much, as I say, it's all about unexpected changes in the pension assets or liabilities. Again, because of the uncertainties that exist in actuarial valuation. So, for example, investment growth, life expectancy of staff, salary growth. What we've got here, though, are 2 things. We've got some money that is being paid to the staff if they leave straight away. I think that's what's described as the basic settlement. So this again is for the staff who have left. And whatever you call it, any adjustment of that nature always goes through the profit and loss. It will increase the expenses, increase the pension liability. That's the double entry. It's the same as a past service cost, so it doesn't matter whether you call it settlement or not. So again, in that case there, Apologies, I think a picture of President Trump just came up. I don't know why, or ex-President Trump, or whatever. Anyway, so in terms of that, the basic settlement is of the nature of a service cost. So ultimately, it's like a past service cost. And as a result, again, the profits will go down and the pension liability will go up. In addition, the company again is putting some money aside for the people who choose to stay while the business is wound down. So the staff who remain or remain temporarily. And the answer is very much the same, certainly at a basic level. So if these staff remain, therefore extra pension is being accrued for them. So just the matching concept really, isn't it? So at the end of the day, that will also give an expense in the P&L. Now up to now, there's about 6 marks worth. The reality is most of us would try and get about 3 by explaining some basics. But the remaining 2 marks are very easy. You must know IAS 37 provisions inside out. It's a very basic standard, isn't it? And when you make any kind of provision for reorganization, which is another word usually for firing people or redundancy, that when you have any kind of reorganization provision, remember that you set up the provision, again, if you can see a constructive obligation. Constructive obligation, again, means that even if you're not legally bound to pay them, then you will have to because of what you've actually done. And again, if there's evidence in the scenario, as there is here, that there's some kind of formal plan and it's been announced to the staff, which it seems to have been, in that case, you recognise a provision. So again, the point is that you would accrue the redundancy costs at the time of the announcement. So I reckon if we don't panic, we should be able to get a comfortable 5 out of 8 on that part of the question. Question 2, part B, very straightforward deferred tax question on losses. So it seems to come up more times than I've had hot dinners. So we're just required to decide whether or not we should recognise deferred tax. First thing is just to explain very briefly why losses are a temporary difference. And remember, the reason is that the loss is accrued now, but tax relief will arise in the future. In order to avoid problems, I recommend that for the exam, people learn in advance whether things are deferred tax assets or liabilities, so you don't have to think about it too much. But I'm sure you know that losses are a deferred tax asset. The problem is that when a company makes losses, it often makes losses the year after, even though management say they expect to make a profit. So can you actually recognize this asset? You can only recognize the asset to the extent you foresee future profits. So it's still an element of good old school prudence. So in this case, again, we would say, look, only recognize if the future profits are realistic. Then you can use the scenario. There are lots of things in the scenario. It says, doesn't it, they can only carry losses forward 2 years. It says they've got a history of losses, so they're not very good. And the market is down. So once you've used the scenario, you can then say, which is normally the answer in these questions, I don't think we should recognise deferred tax asset. So we might be saying you'd be unlikely to recognise the deferred tax asset. Requirement C, the ethics part of the question, in 2 parts. First of all, it's asking us to consider the ethical implications in terms of the way in which the directors have been behaving. So the directors' behaviour. And secondly, it's asking us again to think about the implications for the accountant. The accountant is referred to partway through the scenario where they've been told, again, that's you, really, isn't it? They've been told that they had better do what the directors say, otherwise they're going to be replaced. That's at the end of the paragraph, just before the word tax losses. 7 marks, including 2 of the higher skill marks here. So if you discuss the scenario properly, hopefully you can pick those up, or at least one of them. Things to get across, of course, are look for the drivers of the director's unethical conduct. You can see in the scenario that the directors have an incentive to behave badly. So again, they've got incentives in terms of their bonus, which is linked to profit. So they want the profit to be as high as possible. They've also got an incentive because of the debt covenant. The debt covenant, again, is a promise to the bank that the company's assets will not fall below a certain level or its liabilities not above a certain level. So they've got an incentive to overstate profit, to overstate assets, to understate liabilities. And of course, we can then apply that to the scenario because the changes they've put through would be to understate profits with the pension, to understate profits with the deferred tax, to overstate assets on the deferred tax. So again, apply to the scenario. I'll just put one example down. Again, they want to overstate the deferred tax asset. Always then remember that there's credit going if you mention the ACCA Code of Ethics. After that, explain and apply relevant principles. So apply relevant principles. Personally, I wouldn't write them all out. I just pick the ones that are useful. In this case, the directors are more wicked than ignorant. It's not about their incompetence, it's about their wickedness. So I would probably apply principles like integrity, failure to have straightforward business conduct, or professional behaviour, conduct that would lower, the status of our profession. If you identify the principle, make sure you then briefly explain what it means. Finally, the poor old accountant, of course, because of this manipulation by the directors, they are clearly intimidating him. So the accountant faces an intimidation threat. because she or he is going to get the sack if they don't comply. So essentially again, so that's dismissal. And then think about action that you would take. And generally, you can more or less go down the same route with most of the questions here. As the accountant, I need to look at internal remedies, like talking to the senior management. Remember, the non-executives, those charged with governance, the non-execs. Maybe I'm looking outside the business at legal advice. Maybe I'm considering resignation. Remember, it would be a terrible shame if you spent ages doing an obscure calculation and getting that perfect for 1 mark, and then you didn't spend 10 or 12 minutes on this, because I think this is a place where we could probably score 6 out of the 7 marks. And that would be wonderful.